Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Paris milling wheat. The market here is somewhat different when compared to the ones in the US, though there had previously been some similarities, and one interesting similarity has developed over the last few weeks. The first common feature was the idea of a rounded bottom pattern from June last year through to March this year, something I floated on the other grain markets. For this one here, I looked to the June 25 high at 221.5 as being the key level for the lip of the rounded bottom, just above the super significant 50% absolute Fibonacci line at 218.75, which capped prices with a small double top in mid-March. Thus, so far we have not triggered any intention of an upside move, though this week we might have another try. We might have had another try up there, and maybe even next week. The previous time the market did this, it chose instead to form a dark blue bear channel, currently 200.25 to 211 even, and that's from the small double top made in mid-March. Now, as I said 2 weeks ago, and I quote, this would seem on the surface to thereby cause the big rounded bottom pattern idea to fail, but not so fast. You see, many rounded bottom patterns have a handle, so a rounded bottom, and then you have a handle or extension to them on the right-hand side of the construction. And this is what we are seeing here. The only issue is the steepness, the bearish steepness of this handle. The flatter the handle, the flatter a handle, the better the pattern, and this one is quite steep, end of quote. Well, since then we have seen the handle form over March and April, and in the process not only justify the rounded bottom, but also add a new pattern idea. First off, only on the confirmed break of the 221.5 lip, well, then we would have a primary potential up to the 244 area for secondary potential up off the top of my daily chart in the 256.5 area, and this is for the rounded bottom. However, as I mentioned earlier, the action over March and April has set up conditions for another pattern, one that is shorter in time than the June 25 today rounded bottom, and that is a possible bullish halfway hesitation. So, much like Chicago and Kansas City wheat, and also inspired by what I saw in oilseeds and veg oils yesterday, we might have the action since early February today as one leg of a possible bullish halfway hesitation. I think this is a valid case here, right now at least, so I'll put forward the following targets topside for such a pattern. Therefore, primary target X, wouldn't you believe it, is at 221.25, right on that key earlier lip of the rounded bottom pattern. We next have a secondary, harder to reach target X1, up in the 238.25 area. This nevertheless still looks good as a pattern idea, despite the recent pullback lower, effectively as long as prices can stay above the dark blue lower bull channel line, and ideally above the higher up upper bull channel line, the dark blue one. It will all very much depend on what the market does with that previously mentioned key 221.5 level. Minneapolis wheat. 8 weeks ago, I applied what I said at the time, and I quote, it's an old technical analysis technique, but one that I recall worked well in the grains during the start of the Russo-Ukrainian war back earlier this decade, and that is doubling, tripling, or even more of bull channels, in this case specifically the mid-January to late February bull channel. Now, tripling this higher gives another topside resistance above the next resistance at the April 24 low at 634.75 and close to the 38.2% Fibonacci line of the May to August 24 move at 644.5, end of quote. Making this bull channel quadrupled upwards, and this gave us an even better resistance, holding over most of March and into mid-April, well, sort of, though it had been pierced on the upside. However, what this doubling and tripling and quadrupling upwards has most effectively done is show a March to late April hesitation within a mid-February to date bullish halfway hesitation, much as I originally saw in oilseeds and veg oils and then again today in the grains. This is in addition to another earlier pattern which I described 2 weeks ago when I said, and I quote, "This brings us to the bigger picture here, and we have the same rounded bottom here that we have seen in other grain markets, based on the November 2017 high at 665 and 3/4, which in turn gave us the key June 25 high. That was the start of the rounded bottom. However, also add the 50% Fibonacci on the May to August 24 move that is nearby, a little higher at 669.5. End of quote. I also added at the same time, I quote, "Now, as I've said elsewhere, though we have not broken higher from this rounded bottom, this is not necessarily a bad thing, as rounded bottom patterns sometimes, as here, form a handle or extension to the right-hand side, and that is what we have seen since early March." And that's the end of the quote. Last week, the construction of the handle had been finished, and thus I can now verify the targets for this bullish halfway hesitation of a primary target up in the 684 area and a secondary harder to reach target up in the 723 area. As you can see, I've travelled all the way up on these targets, indicating this market is far further advanced than Chicago and Kansas City. Thus, it is now opportune to lay out targets for the rounded bottom of a primary target X up in the 737.5 area, so not too far away, but a secondary hard to reach target X1 up in the 774 even area, near the top of my daily chart. This is what the situation looks like right now, and as I said earlier, Minneapolis wheat seems farther along when compared to Kansas City or Chicago. It is definitely a leader again. London UK feed wheat, excuse me. In recent weeks, prices have moved up over two key patterns over the very, very important dark blue neckline extension on my daily chart below, currently at 169.10. A neckline to a pair of very long-term patterns, which I will shortly detail. However, what was really happening was the formation and a subsequent move higher over the July 25 to April 26 very large rounded bottom pattern. Her first peak at the absolute 50% absolute Fibonacci line at 180.5. This was done with the most recent pattern driving this market higher, a bright red early March to mid-April bull channel, currently 177.10 to 183.10. Prices broke higher over this panel and with some vengeance late last week and have exploited this move up this week, notably over the 50% absolute Fibonacci line at 180.5. It also saw a significant move up over the dark blue middle time, currently at 181.15, of the new end of June to late October 25 bullish shift pitchfork. I spoke about this bullish shift pitchfork 2 weeks ago when I said, and I quote, "This pitchfork has so far not been tested, so this will be a first if we continue to move higher." End of quote. Well, the middle time did help cap prices along with the bright red upper bull channel line over most of last week and the week before. But as is seemingly always the case, when two such resistances are close together, rather than capping prices, it gives the market an opportunity to knock out two resistances at the same time, which is what happened late last week. Thus, I can now look at the very large rounded bottom formed between July 25 to April 26 and detail some targets above. So we would have a primary target X in the 199.60 area with a secondary harder to reach target X1 up in the top, above the top of my daily chart in the 212 area. Okay, so without all those points being said, let me discuss my final points, the same points I have been discussing here for, well, over a year. As some of them was something that I noted back in my annual commentary back in January 2025. To see these, it's best if we switch to my longer-term monthly charts. Firstly, I saw back then the potential for a very large May 23 to April 25 bearish cat's ears pattern, akin to a double top but formed after a big fall, such as the fall we had in early 2023, and then we have the double top. As well as this, we have an even longer term second pattern, an August 20 to April 25 very large head shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart. Currently 169.10, the same as on the daily chart I just spoke about. From these two longer term bearish patterns, we have a primary target X3 for the bearish cat's ears pattern. That'll be down in the 127.5 zone, and a secondary hard to reach target X4 down in the 112.85 zone. For the head and shoulders top, we have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so, it's actually now 250 or so charts. And that's the 1975 to date, yes, a half-century old uptrend, currently at 66.25. I'm not even going to give you my secondary hard to achieve target for this pattern, as that's below zero. Please, please, please bear in mind that these are very long-term targets stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July 2025 with changeover through a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 today upper bear channel line, which is currently 170.30. This is the same as the purple downtrend seen on my earlier daily chart, the one that the market pushed up over in mid-March and has started to now stabilize over in April. The question this poses, and it's a longer term question, is whether July 2025 was just a reactionary single month move higher or the beginning of something else. I have said for a number of recent weeks, now more than ever before, that these two bearish patterns will not be the way forward, and that we have a base for a move higher. March provided a single monthly close over the bright green upper bear channel line. I would like to see a minimum, at least one more month, consecutive month, over the bright green upper bear channel line to verify this move higher, and ideally over the 50% absolute Fibonacci line at 180.5. Beyond these on the upside, we have the bright red 5-year moving average, which is currently 199.55, and the 50% Fibonacci line, the really big 1975 to 2022 move at 203.25. I can't believe I'm actually talking about a 52-year-old move with a 50% Fibonacci line on it. But that's what it is at the moment.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Services International Limited. And here comes the final important bit.